Let's now look at equity mutual funds. This is Deepak from Market Vision bringing you this presentation as part of our mutual funds module. The different kinds of mutual funds, some of them are purely equity funds, some of them are debt funds, and some of them do a little bit of both. Let's talk in this presentation about the different kinds of equity funds. So you've got broad diversified funds that literally invest in everything and are not so volatile, because if you have 200 stocks or 150 stocks, you're not bound to be very volatile. You get a kicker in these funds from non-index stocks. So Sensex, for instance, has 30 stocks, but some of these funds invest in 100 stocks, so they get exposure to a lot more than just the Sensex. Some of those other stocks kind of tend to go up a little more, and they get a kicker from those stocks movements. You also have sectoral stocks which invest only in a certain sector, and because of that they tend to be highly volatile, because some news that affects real estate, for instance, will affect all the stocks in that sector, and therefore it may not affect the broad market so much, but all the stocks in that sector get affected. But sometimes certain sectors become darlings, like infrastructure or power became a darling in 2008, and IT was a darling in 2000, and you had people running towards these sectors. Usually these sectoral funds in darling sectors tend to happen after all the drama in that sector is over, but that's a different story. But there are good, interesting sectoral funds as well. Third kind of fund is an index fund, which just buys the stock in an index, like the Sensex or the Nifty or one of the mid-cap indices or something like that, which only buys stocks in that index in the same proportion as they are represented in the index. The beta of these index stocks typically 1. That means if the index moves up 1%, the index fund moves up 1%. Nifty moves up 1%, the Nifty index fund will move up 1%, and so on. But the reason why you choose a fund like this is because it's low expense ratio. See, the manager doesn't have to use a lot of brains at this point, because you just have to buy the stock in the index, right? So he doesn't have to select any stocks. All the work is being done at the index level. They can reduce their expenses for index funds. Now let's look at the features of index funds. Nowadays they usually lock you in for a year by putting in an exit load of about 2%, between 1 and 2%. SEBI is trying to rationalize this, but that's the story right now. Dividends are tax free. That means you can, whatever you get as dividends from an equity fund, you don't have to pay any tax on, and even the mutual funds don't have to pay any tax on it. The funda being that if a mutual fund receives dividend from a company, the company's already paid dividend tax. So when the mutual fund gives you dividend, you don't have to pay any tax. But here's the thing: if the mutual fund had bought something for 100 rupees, sold it for 110, made that 10 rupees as profit, and they gave that 10 rupees out as profit, as a dividend to you, they still don't pay any tax. There's a stock market transaction which has yielded a profit, and nobody has ever paid tax. The mutual fund didn't, and because it gave it to you as dividend, you didn't. This is a loophole. I expect it to go away, but it exists right now. Just saying. An equity fund can hold up to 35% cash. Up to about 65% has to be invested in equity for it to qualify as an equity fund, and therefore give tax-free dividend and so on. The equity funds will also invest in derivatives, typically to hedge against losses, and the exposure is limited to amount of money they have. So if they have a 100 crore fund, it cannot have derivatives in that fund which exposes it to more than 100 crores. And in that, if they buy options, the amount of options they buy and what the premium they pay for it cannot be more than 20% of their total portfolio or assets under management. So 100 crore portfolio, you can't have pay more than 20 crores of premium to buy options. They are not allowed to sell options either. So they're very restricted in what they can do in terms of derivatives. Now let's look at different kinds of sector funds. You've got funds that do auto companies, or fast moving consumer goods, infrastructure, technology, telecom, banking, pharma, all these different kinds of funds. But these are a little bit for the show scene, because a fund may say I'll invest in infrastructure, and it'll go buy a banking stock. It may go buy an FMCG stock. They're not infrastructure, but at some point they'll say, well, it can banking. Banking is the infrastructure of the country, so it's part of our mandate. So these are loosely defined concepts. Some of them don't follow it very rigorously. So you have to choose a sector fund with care if you're ever getting into it. There is another kind of equity fund called an equity linked saving scheme. These are tax saving funds. So you get an ATC section deduction of up to 1 lakh rupees per year. This is alongside a number of other random deductions that you get, like for instance your insurance premiums, your children's education payments, your PF, all of them come under the same overall 1 lakh limit. This ELS is one part of those limit, but this tax saving will go away with a direct tax code starting 2012. So you have a year before things get very exciting. So, but even if you were to buy these funds now, remember that it is quite likely that once they become uninteresting after the direct tax code, the managers may say, we don't care about it so much. So you got to be a little careful about buying it today. One of the things is the concept of ELSS funds is they're usually diversified. They're not very sector specific. Some of them are index funds. They're usually broad diversified funds. And because of this tax saving concept, then it's set up to encourage equity investing. So you can't exit before 3 years. So you just can't get out. It's not possible. But there is a way. You can choose a dividend option. Some of these funds give 5 to 10% of their NAVs out as dividend every year. So what happens is you invest 100 rupees, you get the tax saving for the full 100, but the fund gives out a dividend of say 10 rupees. So you only have 90 locked in for the remaining 3 years. So choose dividend. At least some of that locked in money comes back. There are other different kinds of equity funds. So some will classify them as market. So they'll say Reliance Growth Fund, which is a mid-cap fund, or a Reliance Vision Fund, which is a large-cap fund, or somebody Quantum Small-Cap Equity, which is some small-cap fund, and so on. But they lie. What large-cap fund will go invest in small caps or mid-caps? Sometimes just because the market has fallen like 20%, one thing which was a large cap has suddenly become a mid-cap, and you can't do anything. So it's a little bit of drama over there. There's also outcome-based mutual funds. Outcome-based is like, we want to give you income. We'll try our best. We'll go and buy these stocks which have great dividend yields. There are very few stocks which have great dividend yields, honestly. But, they say they'll try, so they kind of excite investors and get them into this. Others will say, forget dividends. The story is growth. India is the next big thing. So let's go get stocks which will grow like crazy, and they go buy like a Suzlon Energy that falls 80% because people aren't buying windmills. But forget that. You have outcome based funds which try to target different kinds of outcomes based on their mandates, and again they violate this quite often. So there are also hybrid funds. We'll talk about them in separate presentations, but these are quasi equity, so they'll do a little bit of equity, a little bit of debt, and maybe they'll balance between that equity and debt and so on with that. And you have lastly, exchange traded funds that are on an exchange. You can buy them or sell them like a stock. They're mutual funds underneath. Another presentation on those because they need some real explanation. There are funds that focus purely on investing in companies abroad. RBI has kind of liberalized the investment regime where you can actually go and put your money into companies abroad up to $200,000 a year. So they allow mutual funds also to help in this process. So there may be mutual funds that says, I'll go invest in gold mining companies abroad. So that's one way to look at a fund, and there are such funds that exist. So that's it from me for today. This is on equity mutual funds. We would love to hear what you have to say. Visit our forums, please. Email us, and our next session is going to be on debt funds. Thanks for listening.